All right, so that's what a bear call credit spread looks like. And here's one that we just did. I just showed you that, but this is an alert service trade that I sent out this past week. And this was on S&P 500 SPX. So I sent it out exactly because of what I just showed you. We had a weekly cycle reversal here, and we had a negative momentum. Plus, I'll show you here in a minute, we had a number of other things that were telling me that this technically looks like it's going to come off. So what we did, we set up a bear call credit spread, and we set this up on the 10th. We set this up on April the 10th. All right, so what was that, Wednesday? And so when we did this trade, the short strike that we sold was the 52.65. That short strike at that point in time, that was a 17 delta, okay? So really, very high probability trade going into this trade starting out. So that would kind of give you that 83% probability just looking at that. But we're using my tools, okay? So this is a moving average cross that I like to look at. My momentum was negative. So everything was stacking up that directionally this looks like it's poised for a pullback. And so then the reason that I selected this was that, okay, this market's been a strong bull market, right? It's been going up. And so, did this because it's in a bull market, longer term. So I was thinking, okay, even if we sold it here and it just kind of maybe goes up and down, maybe it just churns, we'll still make money, because I'm not totally convinced yet that we're going to have a total crater to the market. So a lot of times when I'm, doing kind of a potential counter trend trade, short or long, I'll start out with a credit spread, and then, if the markets start to go more aggressive, then you can use other types of strategies to get more leverage and get more potential profit. But this is a good probability trade to start out with. So doing this trade setup, then sold at 52.65 and bought the 52.70. So that's 65, 52.65. That was a 17 delta. So like 83% probability trade theoretically. And then we took half position off Friday. Sent out alert to take, close out half of it if you had, multiple contracts. So, 30 bucks of credit, collapsed down to 30 bucks. It went out to 30, $40, in the close. So that was a profit of, $70 per spread. That's typically I'll look at, 80, 70, 80, depends on the market, percent of the credit received. So that's an 18% return over 2 days. Now, if we get this thing to expire worthless, this will be about a 25% return. But that's based on it's a probability trade. So again, looking at the market when I'm first starting out for short or long, a lot of times I'll look at these types of trades based on the probability. So it doesn't have to just go straight down. If it just churns and goes like this, we can make money, because the markets are kind of in this transition zone here where they're not quite sure what to do. The trend is getting a little bit long in the tooth, but the markets are still, there's still buyers coming in.